Frequency Podcast Network. Stories that matter, podcasts that resonate.
Well, I think it's time to call the war in the Middle East what it is, a black swan event that central bankers, economists, policymakers, other than maybe the U.S., didn't see coming for 2026. That has thrown all of the projections for economics and inflation out the window and what central banks are going to do with interest rates. We've heard from the Bank of Canada and the U.S. Fed. Bank of Canada Governor Tiff Macklem really kind of summarized it all, saying that the economy's taken a few shots already this year, and it's not likely to improve anytime soon.
The Canadian economy continues to face heightened uncertainty related to U.S. trade policy and geopolitical risks. Now the war in Iran has added a new layer of uncertainty. Its impact on the global and Canadian economies will depend on how long the conflict lasts and the extent to which it spreads across the Middle East. Inflation in Canada has been close to the 2% target for more than a year now. But as we've seen, the war in Iran is causing oil prices to move sharply higher, and this will push inflation up in the near term. Canada's economy is dealing with a lot, and we now face more volatility.
And the biggest thing about the forecast now and what the central bank had to say about interest rates is they kept the overnight interest borrowing costs at 2.25% on the benchmark, was the fact they're not sure what to do next. They're kind of in this wait and see, catch-22, whatever you want to call it. We've got a weak economy, but rising inflationary pressures, and that is not where any central banker wants to be in the possibility of stagflation.
Since we published our January report, employment, we've seen more job losses. It's largely reversed the job gains we saw through the fall. There's a lot of volatility in the export data, so you gotta sort of look through the noise. The housing market remains weak. When we look at the data today compared to what we forecast for Q1 growth back in January, it looks like it's going to come in lower. Looking forward, we would be looking at, well, how is that risk materializing? And yes, if it was materializing further and we didn't have inflationary pressures, I expect we would be talking about lower rates. But, we're operating a world where there's more than one thing going on. We're now facing increased inflation risks. And, those two things go in opposite directions for monetary policy.
Welcome to In This Economy. My name is Mike Eppel. Joining me on the line is Dr. Eric Kam, professor at the Department of Economics at Toronto Metropolitan University. Hello there, Eric. Welcome to Almost Spring.
Thank you very much. It's a pleasure to be here. I'll be even happier when we're in spring.
Well, look, this year, the winter was brutal. The economy kind of stinks. And I'm being blunt because all we've heard really so far this year is, our negative economic signals, Eric. The job numbers for February were terrible. Trade numbers are off a cliff. And Tiff Macklem, the Bank of Canada governor, basically was pointing that out today, talking about the fact that if it wasn't for what's going on with gas prices right now and the specter of rising inflation, they might actually have been, talking about interest rate reductions because that's where the economy is. Inflation in February was 1.8%. You can call that a mirage or whatever. But I think that was a real tell from the central banker that things aren't going all that great.
Things are a mess. And Tiff Macklem, I know, is a very bright man, and he's too honest to just stand up and lie to Canadians like some people do. I don't know if inflation's our worst problem right now, but since we got to start somewhere. The interesting thing about inflation is that before all hell broke loose in the Middle East, inflation in Canada was mostly under control, right? It was about 2.3%, give or take. We know the Bank Canada targets around 2% with the 1 to 3 acceptable range. So by textbook standards, Mike, inflation was basically fixed. The problem is you've got to scratch a little bit before the surface, and you get the fact that, sure, but that's an aggregate. Now let's dig into the micro level. Food, it's still grossly elevated. And it doesn't matter if you look at groceries or restaurant prices, they're all rising super fast, faster than any average. Rent is still increasing. And services in the country are still at about 3% higher than they should be. So the way that the government tends to like to play with this is something called core inflation. Take the core inflation bits, which are the highly volatile elements out of the statistic, and then the statistic looks quite good. But we know that if you put in those volatile bits like gas, and then you throw in what's going on with the war in the Middle East, there's nothing normal about inflation right now. And there's a real risk that it's going to come back and it's going to be very damaging to this country.
Well, look, the fourth quarter GDP was negative. And Macklin pointed out that it was actually weaker than they thought it was going to be when they just made their first forecast for 2026 in mid-January. So that's one thing. If we get a negative print on GDP first quarter this year, that's a recession. Like, there's just no getting around it. Like, and like I said, the job numbers for February were god awful. You know, they're really stuck right now, because if they get, rising inflation, which is in all likelihood a very real possibility if this, I don't see gas prices coming down. They're, the longer the war lasts, the longer the supply disruption, the longer it takes to unwind this mess. So do they, are they just stuck right now between a rock and a hard place?
I think they're very stuck right now. And I think that there's a lot of bad luck going on with the Canadian economy. I used to say that we make our own bad luck. But now it's not that simple, because now you are, as someone described, living above a meth lab. And that's a little bit true, because we know that some of this problems with trade were not really ours, but we've inherited them. The problems with oil, we didn't really create them, but we've inherited them. Now, I could argue that we should not be so dependent on world oil, since we're a staples economy. We have tons of oil. It's under the ground. The problem is the time to build pipelines was 3 weeks ago, and we haven't done that. And in fact, we haven't built significant pipelines in a long time. So let's let that go for a second before we pound on the government. You brought up an incredibly good point. When GDP started to slow, Bank of Canada brought up a new term. I loved it: disinflation. And they said, this isn't deflation. This isn't the economy tanking. This is the increases slowing down. So we're increasing at a slower rate, but still increasing. Now, to your point, that's right. The GDP is actually falling, which means we are in a heap of trouble. And to be blunt, I don't care about labels. I don't need to have 2 consecutive quarters of real GDP falling to know I'm in a recession. Recessions are like love. You don't need to be able to define it. You know when you're in it. And we are in a really sticky situation right now. You bring up the labor market. This is always the last domino to fall before an economy really, gets to the brink of collapse. And I'm not saying we're going to collapse, but if you start to add, people say, okay, well, it's bad. It's about 6 or 7%. No, this is another sleight of hand, Mike, by StatsCan, because we know if you add in discouraged workers that have dropped out of the labor force temporarily, if you add in part-time workers that are looking for full-time work and can't, and you add in those youth unemployment numbers that are just horrific, and some of those people have dropped out, if you leave all those numbers in, I'm telling you our inflation rate is hovering between 10 and 12%. And I think that's
unemployment rate.
I'm sorry, the unemployment rate is about 10 and 12%. That's heinous. And what's going on is a seismic shift. We like to think that the unemployment issue is frictional, right? That's what economists say, that it's frictional, but time will fix it. What you don't want to get into are structural issues in the unemployment rate. But that's exactly where we are, because you have moms and dads taking what we call mixed jobs just to put a roof over their head and feed the kids. So now you've edged out the youth. Where the heck are they going to work if moms and dads are working at fast food establishments?
Yeah. Well, one thing about that, I mean, the numbers in just from StatsCan today about population in 2025 actually dropped to 100,000. First time since Confederation we'd seen a negative growth rate for population. So maybe, that helps stabilize the job market, because there are still going to be jobs that need to be filled. But I was just thinking about this, Eric. When was the last time we actually had good economic signals? Like consistently strong, not the mirage that, GDP was growing but it was based primarily on population growth. When was the last time we actually have seen anything good?
I actually think it was the Harper government. I really do.
Oh my goodness.
I think you've got to go back a long time. I'm not kidding. I think the 11 years of Trudeau on to Carney, I think has really been lost years. I think we are struggling, whether you want to talk about the quote unquote sexy topics, right? The low hanging fruit, low productivity growth, the reliance on a housing market, ultra weak business investment, ridiculous levels of household debt, and then the interprovincial trade barriers that Carney said he was going to fix. I mean, it's been a very long time. Your point's well taken, since people could say we are on the runway to some economic progress, but supply side growth is effectively dead. And that's your long-term push out the barrier for what the economy can do in terms of goods and services. And you can keep lowering the interest rate, the prime rate. You know what? You can lower it to 0 if you really want, but that doesn't create jobs. I know people think it does. It doesn't. All it does is it stabilizes, some ways artificially, some consumer spending so that consumption and investment offset your short-term GDP number. But it is really time, Mike, and I say this, I'm not a policymaker, I'm an economics professor, but it is time that our policymakers get together and realize, how do we get our economy out of the proverbial toilet? We need something. You need some stimulus to get some supply side growth to give this little engine that could a chance.
The past 6 years. I mean, look, we went through a pandemic, which of course, knocked the stuffing out of everything. And then we saw the boom after that with consumers, spending to the max. And this kind of comes to the point about, the need to raise interest rates to fight inflation. Coming out of the pandemic, that was not a supply. It wasn't. We're seeing a supply shock right now. It's not based on demand. Demand was strong post-pandemic, and that fueled a lot of the inflation, among other things. But now it's supply side. You can't really hitting the brakes by raising interest rates. That doesn't correct the supply side issue, does it?
It doesn't do anything on the supply side. You're exactly right. All that it does, I consider it, again, I hate to use terms more than once, but it's low-hanging fruit, Mike. If I want to make my consumption or my spending statistics look a little better, I can lower the interest rate to whatever we want. But that's akin to a magician saying, look over here, don't look over here, right? And to me, the look over here thing is, where are households feeling the pain right now, right? And in the short term, I think it's the higher prices in gas and food. The medium term, we know it's going to be oil. I think the price of gas isn't anywhere near finished climbing. And if what you're saying is correct, and I think it is, then we're going to introduce a new word to the Canadian economy one of these days, and it's called stagflation. Yeah. And that's when you have high inflation and high employment. That was such a phenomenon in the 1950s that an economist named Phillips said they can't both happen at the same time. And somehow we're going to prove Phillips wrong.
Well, it's 1970s too. How many times do we have to do this? It seems like we just keep repeating the same mistakes.
We do. And that goes back to what I said before, is that part of what's frustrating about this is we have oil. We have natural gas. We just have to get it. And there seems to be, and I'd love to ask the Prime Minister, if you have a PhD in economics, and let me tell you, personal experience, some days that doesn't mean a hill of beans, but don't you want to exploit comparative advantages in our country? We have them. They're under the ground. Don't you want to get them and become less reliant? Imagine if we didn't need world oil. And to some extent, we don't, but we haven't cultivated that. Imagine if we could be that country that like the person that owns the Tesla and says, I don't care what gas is. Imagine if we had more of an ability to take our oil and gas out of the ground and say, well, shame what's happening to the world oil price, but luckily we have a buffer. And I think that's what frustrates me sometimes about our country, Mike. We don't seem to have buffers. We don't get buffers anymore. We just seem to be very dogmatic. We wait till a disaster and then we try to deal with it. And I don't think we deal with it very well.
Okay, so a couple of things. You're right about, is this, again, an opportunity for Canada to say, hey, world, we've got a lot of what you want. Come to us. Let's talk. And at the same time, our domestic supply, this is the question you get every time you go to people at the, filling up their tank when there's an energy shock. How come in Canada we have to pay so much when we've got all this oil and gas here at home? Well, global markets and all that stuff. But to some extent, it's right. Why don't we have a strategic reserve of our own that we can say, okay, well, we've got a supply shock. We got all sorts of gas. No issue.
Correct. And that's, it's no different than countries that are rich in gold or silver. They cultivate it, they get reserves, and they have this comparative advantage in whatever it is. They have a comparative advantage. I mean, this is chapter 3 of any economics textbook, right? Produce the things that you do the most efficient, which is another way of saying the cheapest, sell those things and buy the things that are expensive for you to produce. And so you're right. I like to think of the economy always really when I can on the positive. This is a chance. This should be a wake-up sign for all policymakers in this country to say we are far too dependent on far too many countries for far too many goods. And not to go off on a Dennis Millerian type rant here, but who are we kidding that we're starting to increase our trade with, Lower Slobovia, with whom we trade 0.001% of our GDP. We need trade with the United States because in sports, you can't teach height. And in trade, you can't teach geography. And that's our trading partner. We have to work on that. We have to make a deal. The time for arrogance or hubris or ego is over. I mean, you're right. This economy, to your point, and I think it's your point, we need a reset. We need to, in a sense, have different priorities, modern priorities for a modern economy. And we've already done one thing. Let me give them credit. You're right. We have kind of honed in immigration because Trudeau thought immigration was a growth strategy. It wasn't, and it never is. But neither are lowering interest rates. And right now, that seems to be our one-trick pony.
To that point about, selling what we've got to the world and cultivating. And yes, I get the point about getting a trade deal with the United States. You may have noticed we've got a somewhat mercurial president. So I don't know when that's going to be resolved. Having said that, do you think that, again, going back to my earlier point about we keep repeating the same mistakes, and every time there's an oil shock that we go, why didn't we prepare for this? Is there a market? Carney's been talking about, big ideas for the Canadian economy. Can we, and there was already some of this going on before all of the EV rebates and all that kind of stuff was taken away. Can we maybe look at, again, weaning off of oil and gas and getting to alternatives to sell that technology or power or whatever you want to call it to other countries? Is that maybe not, sure, we can do oil and gas, but should we also have a side strategy and take advantage of maybe that as a growth scenario? Because at some point, people are going to say, tired of the being held hostage, if you will, by energy, by oil, by OPEC, whatever, and then maybe that's an idea.
Well, I think it is an idea. I really do. And I have to say, I'm not a resource economist, so I'm not as up on this as I should be to get into the nitty gritty. But I do think the resource cycle dependency that you're talking about is very true, right? We just repeatedly ride commodity booms in oil and minerals and other things. And, what happens is when you hit the boom times, those reforms get postponed so that when the boom times go bust, everyone sits there looking at each other like, well, do you have any good ideas? And so therefore the prices may start to fall in some commodities, go up in other commodities. And it really, underlying weaknesses tend to reappear, and then the cycle repeats. So I think in a sense, Canada's repeated mistakes, as you put them, and I like that term, they come from a bit of a core trade-off, right? I think we sometimes prioritize stability and asset protection a little bit over disruption and growth. And you may say, well, that could lead to, some fewer crashes in a domestic economy, but we know it has very negative ramifications in terms of progress and any type of structural issues that we needed corrected. So someone asked me the other day, is Canada failing randomly? And I said, not really. It implicitly has chosen the same path repeatedly. And if you kind of protect housing, avoid risk, and delay important reforms, the economy is just going to follow the same path. It's called hysteresis. If you don't learn from history, you're absolutely doomed to repeat it. The only question is, how long are the cycles in between?
Well, but that also takes long-term planning. Any of this stuff, you can't just go, election to election and change strategy every 4 years. I mean, we're seeing that in the States. They're on a certain path with Biden, and then Trump comes in and tears everything up and resets everything back. So, that's the biggest frustration I've got. Just as a citizen, it's like we can't seem to figure out one, and we get caught up in this because, again, we're tied so much to the States.
We are tied so much to the States, but I think, again, your point's well taken, and I always preface this to the audience. I'm not a political theorist, but come on. Let's talk about short political cycles versus long-term problems, right? Politicians think in 4-year election cycles. And we know that economics isn't physics. You can't pull a lever and fix it. Fixes in economics, be it productivity, infrastructure, innovation, you're talking 10 or 20 years, right? There's really very little quick wins in economics, except as we've been saying, drop the interest rate and you might look like a star. So, Canada does suffer in a way from it. Also, some fragmented decision making. We know that power is split between 3 levels of governments. And I think there needs to be a little bit more coordination, or you're going to have things stall the way they stall. And I also think, and this you may not think is a terrible thing, I think it's okay to be risk averse as an economic culture. Canada has generally been risk averse. And, we lean toward this model of banking, real estate, natural resources. That's fine. But that also, again, to your point, that really insulates us from having to make difficult long-term decisions. We don't do in Canada very well short-term pain for long-term gain. We choose safe investments, right? We don't take things like slower growth in technology, manufacturing, things like that. So I agree. But you know what? Incumbents resist change, short political cycles, and that short political cycle doesn't match well with what it takes to create long-term economic growth.
Yeah, and then I really fear what all of this is doing to any type of government budgets, and then you need money to do a lot of this stuff, and if you're just going further into the hole, that's an issue for another day, Eric.
It's an issue for another day, Mike, but it's a good one because, as I always say to my students, and I'm not kidding, your credit card has a due date and a limit, and Canada's doesn't. And that's very scary. We can have another conversation. I hope we do one day at what this is doing to future generations. This is the first generation right now, my kids and your kids, that will probably not be as well off as you and me.
Okay, we'll leave it on that uplifting note. Thank you, Eric. It was great talking to you. It's always a pleasure. And let's circle back on these ideas because if anything, the next few months or heck, even tomorrow will bring more things of interest.
They don't call me Little Miss Sunshine for nothing, Mike. Stay healthy.
And that was Dr. Eric Kam, professor of economics at Toronto Metropolitan University. Hey, thanks for listening to the In This Economy podcast. My name is Mike Eppel. You can reach out to me about any ideas or comments or what have you. My email address is always open at mike.eppel@rci.rogers.com. On social, I go by @Eppman. That's EPPMAN. We'll talk again soon.